belong to the Property Academy podcast. I'm your host, Emmett Knight.
Andrew Nicol.
And today on the show, we're talking about, am I ready to go again? Now, this is a weapon of a podcast episode because we're going to get into some really advanced thinking about how to structure your mortgage, especially when you're using off-the-plans new build developments. And we're going to get into this because this comes from a list of the show, Victor, who is actually asked to be described as, quote, Victor, long-time listener of the show, and someone who agrees that you, i.e. Ed, can tell Andrew's joke in a funnier way.
So Victor obviously comes from another country and is English as second language, if he thinks that's the case.
Oh, well, I thought you were going to support Victor. He's ripping into me.
Well, I thought he was saying that you can tell my jokes funnier. You can tell Andrew's joke in a funnier way.
Oh, I thought Victor was ripping into me, but he's ripping into you.
I thought you thought that.
I was about to be like, oh, Victor, no podcasts for you. We're not answering your question.
To tell you the truth, Ed actually messaged me yesterday on Sunday and said, Victor can start his own podcast if he's such a comedian because he thought that you were making fun of him, not me. But no, it's me that he's making fun of.
Oh, well, yeah, so, that's probably legitimate. Okay, fine, Victor, we're going to do your podcast. Now,
see how quickly you become nice again to the fans when you realise that they're complimenting you?
Well, why would they not? Now, let's jump into this, please, Andrew. Now, Victor's got two questions, and I've flipped them around the other way. Really interesting one. So, Victor says, I bought two houses from Opus last year. One's going to be finished mid-2022, the other one at the end of 2022. They've had significant gains because he's bought them off the plans, but he hasn't paid for them yet. So, he bought the house, for instance, in Rolleston. It's got over 100k of equity, so he probably bought it for something like 550, and it's probably worth something like 650 right now.
Probably 670, 700.
It's probably worth 700 by the time he settles it mid-22. And he's saying, can I use the gains now to buy the next house? And if so, can you make me a spreadsheet for this? So can he use the equity that he's got in there because the market's moved to settle that house? And he's also asked some questions around interest rates. Now, we're really going to focus on the equity side because the answer's yes and no, and we're going to give you both what those answers are. But start us off. Can you borrow against equity in houses that don't exist yet, Andrew?
So the short answer here is no, because you don't actually have a property where you can register the mortgage and actually use the value yet at this stage. So if you've got something under construction and it's gone up in value, that's equity that you can essentially bank in your mind. I mean, that's your money, but you can't leverage against it. It's not usable equity or anything like that.
And you don't actually own the land yet is the other thing because you haven't settled it.
Correct. So I guess the next thing is, can you use equity from that property, so the increased equity, as part of your deposit? So let's think about it this way. You signed up for a property at $500,000 and you're going to borrow 80% of that, so $400,000. Now it's worth $600,000. Can you borrow 80% of the new value, which would be $480,000, which means that you only need $20,000 of cash or usable equity in your own house?
So let me just walk through this again because that was a bit quick for me. So you're saying that if I'm only going to pay $500K for this house, and if the new value is $600K, the maximum I could borrow against it, because it's a new build, is $480. Could I borrow all of that against the security of the investment property?
Yeah, and the short answer here is no. And the reason for that is banks will always go off the lowest of the purchase price or evaluation. So if your valuation says $600,000 in this instance, they will still use $500,000 because that's what you're paying for it. That's the lower of the two. Where it can differ, though, is if you use non-bank lenders. So I was just talking to someone from Catalyst Financial, and they said that they've just actually had a non-bank lender, Avanti, do exactly this. So a person has bought 3 investment properties. They've come up for settlement. The value has gone up so much that it's their entire 20% deposit, and Avanti, at a higher rate, 4.5%, are settling that property completely unencumbered by any other securities.
Well, the great benefit behind that is that if you were going to use your own home as the security, as the deposit to go buy those 3 investment properties, and they've gone up so much that they're able to, I guess, settle themselves, then that means means, well, hey, you got all this equity in your own home, so you can go buy the next two.
Absolutely.
You'd have to consider servicing, of course, because now you're talking about having 5 investment properties, all with a lot of debt against them. But if your income's high enough, at least you'd be there from an equity perspective.
Absolutely.
Well, I guess the next thing as well that people are probably thinking is, well, let's say that I don't go to Avanti or a non-bank lender. Why don't I just wait 6 months? Let's say the property's worth 600K. I bought it for 500K. Why don't I just wait 6 months, get a registered valuation, revalue the property, and then borrow 80% against the new value? And the issue with this, which I think people know the rules, but they forget what the rules are and how to implement them, is as soon as you settle that property, it's no longer a new build. So your LVR is no longer 80%. You can't borrow up to 80% of the value. You can only borrow up to 60% of that value. So if you went and got it revalued, it's now worth 600K, the maximum you can borrow against it is 360. And so because you're going to be borrowing 400K against it from the start, you know, there's no extra value there. So you wouldn't be able to go down that route. You could either use the non-bank strategy, or there is a much more advanced strategy if you want to deal with the main banks. Walk us through what this is, Andrew, because it's quite interesting.
So this is where you can actually have everything with one bank with the plan to move it later on. So you settle with your main bank. So you don't split bank at all. You settle 100% of the new investment property with your bank. So you've got 500K secured against that, but the asset's worth 600,000, say, for example. You put it on a 6-month fixed term because that's the normal time frame that a new bank would accept an increased valuation. Then you refinance to a new bank under the dollar for dollar exemption rule, which means you can pick up that mortgage, move it to another bank. The bank doesn't have any LVR restrictions under a refinance scenario in this case. So they can lend you whatever they like. They won't lend you any more than 80%, generally speaking. So make that your target. If the mortgage is more than 80% of the value when you move it to your new bank, you can leave the residual part there. So for example, in that case, 80% of 600,000 is 480. You got a 500K mortgage. So that means you can refinance 480 across. You're still going to have 20,000 left with your primary bank, but it's just a small amount that's left there. You've freed up lots of usable equity.
Now, the key thing that you've got to remember that's different when you split bank versus using one bank is that if you split bank, your 20% deposit, that's going to be at your first bank. That's going to be against your owner-occupier, and 80% of the money, the other 4/5, is going to be against the investment property at the new bank. Now, what is different when you use one bank is that doesn't happen. 100% of the debt is secured against the investment property, and those two properties are cross-collateralized. Now, we're going to talk about that more in probably tomorrow's episode, actually. But the key thing to note is because you're borrowing 100% against the investment property, that means the mortgage is larger, so that when you move away, when you change banks, you can take a greater proportion of that away with you. Now, what does that do? Well, you've still got 20K left against your own home with your first bank, but you've got an extra 80K worth of usable equity now that you can then use in order to be able to go and purchase some more investment properties. So that gives you about 400K worth of purchasing power, what you could actually go out and purchase a property with. Now, that's probably not enough to go and purchase something in today's market, but if you add that on to an extra 20 or 40K that you've got within your own property that you still had there, then that might make the difference. So just to walk you through again what you'd do in that case, Victor, you'd potentially, after you get some advice from your mortgage broker, settle the property with your main bank. So you do what we usually tell you not to do. Wait 6 months, then refinance it away. And I know what you're probably saying, guys, just thinking, you keep telling me to split bank. Why are you telling me not to do it? And now that we've drummed it into you, we are taking a bit more of a nuanced approach and saying, hey, in some very advanced situations like this, you might go with a one bank strategy and then use split banking as a second step in order to get you closer to your goals much more quickly. And this is really when it comes down to, and we always say this, investment property or being successful in property investment is more about the finance. It's more about the investment than the actual property, because if you can move money around around in the correct way, then you will be able to grow a much larger property portfolio than you would otherwise be able to do.
Absolutely. So let's talk about some of the catches, the costs and the risks with doing something like this. Sometimes bank interpretation can limit you. So the dollar for dollar exemption is in place from the Reserve Bank. Every bank has their own policy internally that they look at. And I know I've had conversations with Westpac not so long ago where their policy, or what one of their managers said that their policy means that you've got to take the entire mortgage across. So if in the example that we gave before, there was going to be 20,000 left over, they wouldn't allow you to do the dollar for dollar exemption across to them. Now, I do know of instances where they've signed that off anyway, but it's just something you've got to be aware of.
Is this where you called up the Reserve Bank to get clarification on this?
Absolutely. So because I was going in for a meeting with them to basically debate this, because they said that it was acting outside the spirit of the code, I went back to the Reserve Bank and said, tell me, is this what you actually intended? And they said no. So I went in there fully.
Did you get Adrian on the phone?
I didn't get Adrian on the phone. But they were very, very helpful, by the way. Another thing is you got to remember that you could split the loans a little bit. So if you wanted to kind of protect against this, maybe when you set up your loans, you could set up an 80% loan and then two 10% loans. And that way you've got a bit of flexibility that if you can only move 90% across, you can pick up loans A, B, and you can leave C, that 10% loan there. One thing is you're probably going to have to pay the cash back to the bank. If you get a cash back from the bank when you draw down your main investment loan, chances are there'll be an agreement that if you refinance within 2 years or something like that, you've got to pay that back to the bank. Plus, you're probably only going to be fixing for 6 months. So you're probably going to pay a slightly higher interest rate, or when you move across, you might pay another higher interest rate. So just something to be aware of. There will, of course, be legal fees, extra set of legal fees, because you've got essentially a refinance. So that might cost you $1,500. You will get a cash back from the new bank, generally speaking, unless you're using a non-bank lender. So that will offset some of those costs there.
And the other thing is that you're potentially going to have an opportunity cost. So you might have settled that property and be on like an ASB back my build rate or the ANZ 1.68%. So really low floating interest rate. And of course, if you refinance that, well, it's no longer a new build. So you're not going to be able to access those ultra cheap interest rates. Now, I think those are all trade-offs that are relatively reasonable, because this is all about, well, how do I keep purchasing property more quickly? And the overarching benefit of doing that is going to outweigh these extra costs most of the time.
You've got to decide what kind of investor. I mean, if you've got heaps of usable equity in your own house and you don't mind everything being cross-secured, then you might just stick with doing it all with your bank ASB and getting all those extras and not having any hassle of moving it across. If, on the other hand, you want a really big portfolio, then this is something you need to be thinking about.
And I guess the other question is, well, if I want to do all of this, Ed and Andrew, what do I actually do here? And I think the key thing, you got to do two things. You got to have a weapon of a mortgage broker. You got to have somebody who really understands this stuff, who's not green behind the ears, and who understands the investment side. Because there are a lot of great mortgage brokers. Some are probably more specialised, I think it'd be fair to say, to owner-occupiers, rather than dishing out investments and really understanding how to structure these loans to put you in the best position. And I think the other thing you might have to do is encourage your mortgage broker to think a little bit laterally sometimes. Sometimes you do have to just push them a little bit, because if they're finding it easy just writing mortgages all day and your one's a little bit more difficult, I think, sometimes just give them a wee bit of a push,
Yes.
Encourage them to think a bit more laterally in terms of, is there any way we could do this? How do we do it? If we were to do it, how, what steps would we have to take? These kinds of things to get it across the line. Is that fair enough to say?
Absolutely. And I think it's one of those instances where you do want to be using a broker who's a specialist, not going to the bank yourself. I have had conversations with banks where they don't even know about the dollar for dollar refinance exemption.
Now, last question, quick fire for Victor. 1 year interest rate versus something else. What would you be doing, Andrew?
Well, it depends on your circumstance, Victor. But the 1 year rate, if you want a low rate, then absolutely. If you want certainty, then maybe it's worth paying a little bit more to get a longer term.
Fantastic. Let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. Really does help us get the message out to more people. And make sure you tune in tomorrow. We're going to be doing a jargon buster. We're talking about cross-collateralization. Oh, it's going to be...
mouthful.
I know that sounds quite boring, guys, but you should tune in for it because it's actually going to be a very, very good episode. Hey, and make sure you tune in for tonight. We are going to have our monthly webinar. We're going to be talking about how to get more money out of the bank. So make sure you tune in. Tap or swipe over the cover up. There'll be a link in there. Or just go to opuspartners.co.nz and you'll be able to sign up. Thanks for listening to the Property Academy podcast. I'm your host, Emmett Knight.
I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.